It is Thursday morning, February 5, 2026. You wake up, pour a cup of coffee, and look at the electronic board. Everything looks normal. The red and green numbers are still blinking, but know that is a fake piece in a morgue. Because Wednesday, the free market as we knew it officially took its last breath. The numbers you are seeing on the screen right now, they are ghosts. The cold reality is that the vaults in Switzerland are reporting a round number of zero, not a single bar of silver left to deliver. While you are casually drinking your coffee, bank executives in London are panicking, trying to find 14.8 million ounces of silver to deliver to the mysterious buyers who placed orders earlier this week. I have a slightly strange request. Do not hit that subscribe button yet. Do not like the video either. Put your mouse away, just listen first. I have not proven anything to you yet, have I? If in 10 minutes, these data points save your portfolio, you can come back and thank me then. For now, just keep a cool head. I need you to do just one thing. Turn off the television. Close the other entertainment tabs, and focus absolutely on this. What I am about to say is not a prediction, but a live report from the scene of an economic collision that cannot be reversed. And just so I know I am not talking into the void in the middle of this insane market. Let us strip away the emotion and look at the architecture of the failure. What happened on Wednesday was not a robbery, it was a mathematical inevitability. The system did not crash because of a glitch, it crashed because the divergence between the algorithmic price and the physical reality exceeded the system's tolerance levels. We are looking at a complete decoupling of the derivative market from the underlying asset. First, let us dissect the mechanism of the distortion. We have obtained forensic data regarding the high-frequency trading algorithms used by the major bullion banks. This is not about rigging in the emotional sense. It is about latency arbitrage. The data reveals that for years, these algorithms have utilized a 3-millisecond window to front-run institutional orders. They create a phantom wall of supply, thousands of contracts that exist only for a fraction of a second to trigger stop-loss cascades. However, on February 4th, this mechanism broke. Why? Because a new counterparty entered the arena. A $100 million position was opened, not by a speculator, but by an entity that demanded immediate settlement. The algorithm tried to execute its standard spoof and retreat protocol, but it failed because the buyer did not flinch. They absorbed the liquidity vacuum. This is the financial equivalent of a high-speed train hitting a concrete wall. The $1 billion fine mentioned in the reports is irrelevant. It is merely an operational expense, a toll booth fee on a highway that has now collapsed. Now, shift your attention to the physical infrastructure. The most critical data point is not on the COMEX, it is in Zurich. The Swiss refineries are the lungs of the global silver market. They purify the metal that feeds the industrial giants of Europe. The report stating zero stock is a supply chain cardiac arrest. It implies that the backwardation, the premium paid for immediate delivery, has become infinite. In professional terms, we call this a delivery default event. When the clearing price is $86, but the physical availability is zero. The price discovery mechanism has ceased to function. This brings us to the anomaly in New York. We must analyze the volume data from the first 96 hours of February. This requires a cold, hard look at the open interest versus delivery notices. February is a non-delivery month. Historically, the volume should be negligible. Yet, we witnessed 2,955 delivery notices. Do the math, 2,955 contracts times 5,000 ounces, that is nearly 15 million ounces of physical metal moving out of the registered category in 4 days. This is a Six Sigma event. It is a statistical impossibility under normal market conditions. The forensic analysis of the trade logs shows that these positions were opened and exercised almost simultaneously. This was not trading. This was a raid. This was a strategic liquidity drain executed by entities, likely sovereign wealth funds or industrial consortiums, who realized that the paper price had become detached from reality. They engaged in a regulatory arbitrage, using the COMEX rulebook against the banks to extract physical assets at a discount. And finally, we must address the structural shift from Washington. The announcement by the Vice President regarding price floors is the most significant structural change since 1971. Ignore the political rhetoric. Focus on the economic implication. By establishing a floor price for critical minerals, the United States government has effectively removed the put option from the short sellers. In a free market, price seeks equilibrium. But we are no longer in a free market. We have entered a managed scarcity regime. When a sovereign entity declares a floor, they are monetizing the strategic reserve. They are telling the market that the cost of capital for shorting silver is now infinite. The downside risk is capped by the Treasury, while the upside risk is uncapped by the physical shortage. This is not a bull market. This is a repricing event dictated by national security protocols. The free market did not die, it was nationalized. To understand the severity of this fracture, we must consult the ledger of history. Markets have short memories, but the data never forgets. What we are witnessing today is not an isolated anomaly. It is the violent resolution of a cycle that began 46 years ago. We must perform a comparative analysis between the three major silver squeezes to understand why this time the outcome is mathematically guaranteed to be different. Let us look at Exhibit A, the year 1980, the Hunt brothers. Two oil tycoons from Texas who attempted to corner the silver market. They succeeded in driving the price from $6 to $50. But their strategy had a fatal structural flaw. They used leverage. They bought silver on margin using borrowed money. The establishment simply changed the rules. The exchange raised margin requirements, forcing the Hunt bros to liquidate. They were crushed, not by market forces, but by regulatory violence. Now look at Exhibit B, the year 2011. Silver once again touched $50, and once again the price was smashed down to $13 over the next few years. How? Through the paper market. The bullion banks flooded the COMEX with naked short contracts selling silver that did not exist to dilute the price. Investors panicked and sold. The banks won because the investors were weak hands holding paper receipts, not physical metal. Now bring your attention to Exhibit C, the year 2026 today. The setup looks similar on the surface, but the underlying mechanics have completely inverted. The entities raiding the COMEX this week are not two brothers from Texas using leverage. They are sovereign wealth funds and strategic industrial consortiums, and most importantly, they are not using margin. They are paying cash. You cannot issue a margin call on a buyer who pays 100% upfront and takes physical delivery. You cannot scare a buyer who wants the metal for a missile guidance system or a solar farm by lowering the paper price. If you lower the price to $50, they do not sell. They say thank you, and they buy twice as much. The weapon that the banks used in 1980 and 2011, the margin call, is useless against a cash buyer who intends to keep the metal forever. This brings us to the most critical shift in the global financial architecture, the rotation of capital from west to east. We call this the Great Migration. For the last 2 decades, the West has controlled the price of silver, but the East has controlled the physical inventory. It was a convenient arrangement. London set the price, and Shanghai accepted it. But on January 1, 2026, that arrangement ended when China implemented the new export licensing requirements, effectively banning the export of silver. They severed the link. They told the world that silver is no longer a commodity to be traded. It is a strategic national asset to be hoarded. Let us analyze the arbitrage window that this created. For the last 30 days, we have seen a pricing anomaly that should be impossible in an efficient market. The price of silver on the Shanghai Gold Exchange has been trading consistently $7 to $10 higher than the spot price in London and New York. In a functioning market, traders would buy low in London and sell high in Shanghai to close that gap. But the gap is not closing, it is widening. Why? Because the metal is flowing one way. It is leaving the vaults of the London Bullion Market Association, LBMA, and the COMEX, and it is disappearing into the strategic reserves of the East. This explains the desperation behind the announcement. From Vice President J.D. Vance, connect the dots. Why would the United States government suddenly announce a price floor? Why would they abandon free market principles to guarantee a minimum price for silver? Because they realized they were being drained. They looked at the data. They saw that every time the banks in New York smashed the paper price down to $70 or $80, the physical inventory flowed out of the country faster. The low price was effectively a subsidy for China. The United States was selling its strategic heritage at a discount to its geopolitical rival. The implementation of the price floor is not a bailout for investors. It is a desperate measure of capital controls, disguised as support. By setting a floor at $100, whatever the final number may be, the United States is attempting to stop the bleeding. They are trying to make it too expensive for foreign entities to raid the remaining inventory. We are witnessing the weaponization of the periodic table. Silver has graduated from being a speculative asset to a matter of national security. In 1980, it was about greed. In 2011, it was about banking solvency. In 2026, it is about industrial survival. The implications for the supply chain are catastrophic. We must look at the industrial demand profile. This is not about jewelry or silverware. This is about the energy transition and the military-industrial complex. The Zero Stock Report from Switzerland is the first domino. When Volkswagen, Siemens and Samsung realize they cannot source the silver paste required for their electronics because the Swiss refineries are empty, they will bypass the futures market entirely. They will approach the mining companies directly. We will see the emergence of off-market contracts. Miners will stop selling their production to the COMEX or the LBMA. They will sign exclusive supply agreements with Apple, with Tesla, with Raytheon. the public price, the price you see on the ticker, will become irrelevant because there will be no volume traded at that price. The real price will be hidden in private contracts, likely 50% to 100% higher than the spot price. This is the definition of a failed market. When the spot price no longer commands delivery, it becomes a museum piece, a relic. The current volatility we are seeing, the 14 million ounce rate on the COMEX, is just the initial scramble for the last remaining unallocated bars. So as we close the book on the historical context, understand this: the era of the paper short is over, because the physical long has taken the board. The East has the metal, the West has the printing press, and now the West is forced to use that printing press to nationalize the price. Admitting that the free market has failed to protect the asset, we are now entering the final phase of the analysis, the industrial reality. We need to look at what happens when the unstoppable force of the green energy revolution meets the immovable object of an empty vault. While investors buy silver to protect their wealth, industry buys silver because they have no choice. This is the difference between discretionary desire and existential necessity. In economics, we call this price inelasticity. If the price of a luxury handbag doubles, you simply do not buy it. But if you are a missile manufacturer like Raytheon, or an electric vehicle giant like Tesla, and the price of silver doubles, you do not stop buying. You cannot. Silver is the most conductive metal on the periodic table. There is no substitute. You cannot use copper. It is too slow. You cannot use gold. It is too expensive. To make a Tomahawk missile fly, to make a solar panel generate efficiency, to make an artificial intelligence server process data, you need silver. And this is where the zero stock report from Switzerland triggers a heart attack in the global supply chain. For the last decade, industrial procurement managers have operated on a just-in-time delivery model. They kept zero inventory, relying on the London and Zurich vaults to deliver metal whenever they needed it, usually within 48 hours. They treated the global stockpile as their personal warehouse, but as of yesterday, that warehouse is locked. Let us simulate the conversation that is happening right now, at this very second, in the procurement offices of Volkswagen, Samsung, and Apple. A procurement officer picks up the phone to call their bullion supplier in Zurich. They need 5 tons of industrial-grade silver paste for next month's chip production. The supplier on the other end of the line, the same supplier who just admitted to having zero stock, has to deliver the news. I cannot fill your order. The officer offers to pay a premium. I will pay spot plus $2. The supplier refuses. I will pay spot plus $5. The supplier refuses. The officer screams, "Name your price." And the supplier replies with the most terrifying sentence in business: the price does not matter. The metal does not exist. This is the moment of industrial asphyxiation. When the supply line is cut, the assembly line stops. And when the assembly line stops, the losses are measured not in millions, but in billions. A lack of $50 worth of silver can prevent the sale of a $50,000 electric vehicle. The leverage ratio of that disruption is 1,000 to 1. This panic is already visible in the shadow price. While the COMEX screen shows $86, the real transactions between miners and industrial users are happening at vastly different levels. We are receiving reports of offtake agreements being signed in panic. Tech giants are bypassing the banks entirely. They are flying directly to Mexico, directly to Peru, knocking on the doors of the mining companies, and offering to buy their entire production for the next 5 years. They are offering to pay $100, $120 per ounce up front, just to guarantee delivery. They are front-running the exchange. They are draining the liquidity before it ever reaches New York. The COMEX is becoming a market of leftovers. The best metal, the purest bars, are being fenced off by strategic industries under the protection of the new government price floors. Let us look at the specific sectors that are driving this hunger. First, the solar industry. The mandate for green energy is legally binding in the European Union and California. They must install gigawatts of solar capacity by 2030. New solar technologies like POPCon and HJT cells use 50% to 80% more silver than previous generations. They calculated their costs based on $20 silver. They did not calculate for a world where silver is unobtainable. But they cannot stop. The government mandates force them to buy at any price. Second, the military-industrial complex. We are living in a time of escalating geopolitical tension. Drones, satellites, guided munitions, they all run on silver contacts. The United States Department of Defense does not care if silver is $80 or $800, they print the money. They will secure the metal first. The creation of the critical minerals trading bloc announced by Vice President Vance is effectively a military requisition order. It prioritizes defense contractors over private investors. Third, the AI revolution. Everyone talks about the chips, the NVIDIAs, the processors, but nobody talks about the physical infrastructure required to connect them. the high-speed interconnects, the server farm switches. The power distribution units, they require massive amounts of silver to reduce heat and resistance. You cannot build the future of artificial intelligence on copper wiring. It will burn out. So, combine these three forces, an unyielding demand from green energy, defense, and tech. Now collide that with the supply shock we analyzed in Part A. The Chinese export ban removes 60% of the refined supply. The Swiss warehouse emptiness removes the buffer. The COMEX raid removes the liquidity. What you get is a supply squeeze of biblical proportions. The premiums on physical coins and bars for retail investors, people like you, are about to explode. Dealers are already widening their spreads. Soon you will see a phenomenon where the spot price on TV is $86, but if you walk into a coin shop, the cheapest ounce you can buy will be $120. The paper price becomes a fiction. The physical price becomes the reality. We are seeing the bifurcation of the market. There is the paper silver that bankers trade, which is abundant and cheap because it is imaginary. And there is the strategic silver that industry needs, which is scarce and rapidly repricing toward 3 digits. If you are holding physical metal right now, you are holding a ticket to the only lifeboat on a sinking ship. The industrial giants are about to realize that they are competing with you for the same limited ounces, and they have deeper pockets. But you have the first mover advantage. You have the metal in your hand. The panic phase has just begun. The procurement officers are still in shock. Next week, the shock turns into desperation, and that is when the price floor of $100 will look like a bargain. We have finished poking around the crime scene. We have seen the empty vaults in Switzerland and the panic in New York. Now let us answer the only question that actually matters to your bank account. What do we do now? Usually, trading is hard. You have to guess if the price goes up or down. But thanks to the Vice President's announcement yesterday, trading silver just became the easiest job in the world. Why? Because the United States government just handed you a cheat code. It is called asymmetric risk, but let us use plain English. It is a heads I win, tails the government loses situation. By announcing a price floor, the government has effectively given you a refund guarantee. If the price of silver crashes, Uncle Sam has promised to buy it to save the mines. If the price skyrockets because there is no metal left, you keep the profit. Think about how ridiculous that is. It is like walking into a casino and the pit boss tells you, if you lose, I will give you your money back. If you win, you keep the millions. You would be an idiot not to take that bet. But here is the catch. This free lunch only lasts for about 14 days. Why 14 days? Because that is how long the banks have to figure out how to deliver 15 million ounces of silver that they do not have. They are currently looking under the sofa cushions in London trying to find bars. When they fail which, they will, the game stops. So for the next 2 weeks, we are looking at 3 simple scenarios. Scenario 1. The nothing to see here rally. This is the most likely outcome. The government quietly signs the paperwork. The banks realize they are beaten and switch sides. They stop selling and start buying to cover their mistakes. The price moves from $86 to $120. It will be fast, but it will be orderly. In this scenario, your job is to do absolutely nothing. Sit on your hands. Do not sell at $100. $100 is just the new zero. Scenario 2. The oops moment. This is the messy one. A big company like Tesla or Samsung calls their supplier and says, "We need metal now," and the supplier says, "We are out." News leaks, panic spreads. The stock market freaks out. The paper price on your screen might freeze or even drop because the computer is broken. But the real price, the price to actually hold a bar in your hand, doubles overnight. If this happens, do not look at the spot price. It is a glitch in the matrix. Scenario 3. The last trap. This is the one you need to watch out for. The banks might try one last desperate trick. They might dump all their remaining paper contracts to smash the price down to $70 tomorrow. They want to scare you. They want you to think, oh no, the crash is coming, so you sell your real silver to them. Do not fall for it. It is a bear trap. If you see the price crash in the next few days, smile. It is just a going out of business sale. So, here are your marching orders for the next 14 days. First, turn off the ticker. Seriously, the price you see on TV is fake. It is a legacy number generated by a broken algorithm. Watching it will only raise your blood pressure. If the screen says silver is $80 but your local dealer charges $120 to sell you a coin, guess which price is real? The one you have to pay. Second, do not fight the whale. For 50 years, the government hated silver. They wanted it cheap. Now they need it for missiles and solar panels. They want the price high enough to keep mines open. The United States government is now the biggest silver bull on the planet. Never bet against the guy who owns the printing press. You are finally on the winning team. Third, the exit strategy. People keep asking me, when do I sell? The answer is, why would you trade a lifeboat for a ticket on the Titanic? We are moving into a new system where resources matter more than paper currency. In this new world, silver is not just a trade, it is insurance. You do not sell your insurance policy while the house is on fire. The free market had a good run, but it died yesterday morning. We are now in the era of managed scarcity. The next 14 days will be chaotic, loud, and confusing. You will see headlines that make no sense. But you have the map. You know the vaults are empty. You know the government has put a floor under the price, and you know the banks are running out of time.